Hi, I am Soumya Jain. Welcome to Weekly Economic Insights, where we discuss the latest news and updates that affect your personal finances. In today's segments, we'll begin with an expert's view on the SEBI's ease of rules for investment advisors. SEBI is moving to ease the path for registered investment advisors. They're proposing lower education requirements, removing work experience needs, and cutting costs. However, some existing advisors worry about maintaining quality standards with these relaxed rules. SEBI believes these changes will help meet India's growing demand for financial advice. Let's see what our experts think about this. We have Kalpesh Ashar, founder of Full Circle Financial Planners and Advisors.
So the much-awaited SEBI consultation paper on RIAs is out, which was awaited for a long time now. There are basically six major points concerning RIAs per se. So I'll let you know what those six are. First and foremost, in the educational barrier which was there, now all the SEBI existing RIAs who were required to have a postgraduate degree to be eligible for that, now that has been done away with, and only a graduate degree is enough to become an RIA on the education front. The same applies to recruitment of employees who work for RIAs, that they needed to pass the NISM 10A 10B exam. That has been done away with, and even graduates from any stream can be recruited by RIAs now. The second important part in the educational front or the qualification front is that the existing RIAs had to compulsorily pass out a certification, which is the NISM 10A 10B, every 3 years. That has been done away with because the same criterion has now been shifted and eased out, in fact, to just passing out a refresher course or a CPE type of a model, where only the relevant changes which have been made to the fields which RIA address, they have to refresh themselves or keep in pace with that and have that education course done. That is the other important aspect. Second is the flexibility in which the RIAs can charge the customers. So the fixed fee model remains same at 1,25,000. The assets under advisory percentage remains the same at 2.5%. But what changes here is basically that there is flexibility to move between either of the models in between a letter of engagement between the consent of the advisor and the client. So that's the third one. The fourth one is the compulsory net worth, which was to be maintained by individual RIA at 5 lakh and corporate RIA at 50 lakh. That has now been eased substantially, and that has now been kept in a range of 1 lakh to 10 lakh, depending on the clients which the individual or the corporate RIA respectively handles. So that is a welcome move. The second is that the limit of customers, the eligibility of 150, if you are handling an individual RIA was handling, if that was breached to 150 to become a corporate RIA, that has been done away with, and that has been increased to 300. And finally, now that the RIAs now have to limit their advisory only to SEBI-regulated products which are there. And finally, now there is also a proposal to allow part-time RIAs to impart their advisory, but only that is limited up to having 75 clients.
Thank you for sharing your insights. Now let's talk about the latest economic data. India's retail inflation fell to a 59-month low of 3.54% in July, mainly due to a higher base effect from last year. Food inflation also decreased to a 5.42%. However, core inflation rose slightly to 3.4%. Economists expect inflation to stay low in August but may increase later. The RBI is closely monitoring these trends as they make decisions about interest rates. Despite the low headline number, some concerns remain about cereal and pulse prices, which is still high. The monsoon progress in the coming weeks will be crucial for the food inflation. The RBI has projected CPI inflation to average 4.5% in FY25, which is still higher than its 4% target. Lower inflation can lead to better consumer purchasing power and potentially higher real investment returns, benefiting savers and investors. Now let's look at some good news for taxpayers. the finance minister announced that the average time to process income tax returns has dropped from 93 days in 2013 to 14 to just 10 days in 2023 to 24. This improvement is due to better digital infrastructure, automated processing, and Aadhaar-based verification. However, more complex returns may still take longer to process. Introducing a new tax filing portal in 2021 has also contributed to faster processing. The early release of ITR utilities this year is expected to speed up the process further. Taxpayers filing simple ITR 1 form can expect refunds within a few days, while more complex ITR 2 and ITR 3 forms may take a couple of months. Faster tax refunds can improve cash flow for individuals and businesses, allowing for better financial planning and reducing the burden of waiting for rightful dues. Let's turn our attention to a proposal from the RBI. The Reserve Bank of India is considering a risk-based pricing system for deposit insurance. This would mean banks with higher risk profiles would pay higher insurance premiums. The goal is to encourage better bank risk management and increase stability in the digital banking era. However, some worry this could label certain banks as weak. The proposal addresses vulnerabilities associated with rapid deposit withdrawals in the digital age. The current deposit insurance schemes cover up to Rs 5 lakh per depositor. The RBI suggests using supervisory rating to inform premium rates and intervention strategies, providing a more nuanced understanding of each bank's risk profile. This change could lead to a more stable banking system, giving depositors more confidence in their bank's safety and potentially positively influencing personal finance decisions. Now let's discuss the SEBI's new F&O norms. SEBI has proposed new measures for futures and option trading, which could significantly impact stock exchanges and brokers. The proposals include increasing minimum contract size, upfront collection of option premiums, reducing the number of weekly option contracts. These changes could lead to a 30 to 40% decrease in market volumes. Discount brokers rely heavily on retail investors and are expected to be more affected than full-service brokers. The National Stock Exchange might see a bigger impact than the Bombay Stock Exchange. Due to its higher reliance on option trading revenue, these measures aim to enhance investor protection and promote market stability. Stricter regulation on derivative tradings may increase costs for investors and brokers, potentially affecting trading volumes and liquidity. However, they could also lead to more stable and less speculative markets. Finally, moving on to Hindenburg's allegation. Hindenburg Research has escalated its feud with SEBI and its chief, Madhavi Puri Buch, alleging conflict of interest related to the Adani Group. The US short seller claimed that Buch and her husband had stakes in offshore funds linked to Adani, raising serious concerns. Hindenburg also accused Buch of maintaining active consulting firms while serving as SEBI chief, questioning the transparency of these companies. The Buch and their associated firms 361 denied any wrongdoing, stating that the fund in question never invested in Adani securities. SEBI defended its handling of the Adani-Hindenburg matter, saying 23 of 24 investigations are complete. The regulator has also initiated proceedings against Hindenburg Research for allegedly misleading disclosures. This ongoing dispute highlights the complex relationship in India's financial sector and the challenges of maintaining regulatory independence. That's a wrap for this week's Economic Insight. We have explored major shifts across various sectors, reminding us just how dynamic the financial landscape can be. Stay informed to navigate these changes and make informed decisions about your financial future.